Welcome to the Loan Officer Training with the Mortgage Calculator. Today we're going to be talking about how to quote and structure ground up construction loans. The last training we did this essentially with fix and flips, and now we're going to be talking about ground up construction. We'll give it just a minute here. Give us a minute to go live on all the different platforms because we do stream this on Facebook, YouTube, LinkedIn, and Instagram. So give us a minute here to just go live. We appreciate everybody tuning in early. Please drop a comment there in the chat as you tune in. We appreciate it. And you can also drop any questions you have in the chat as we go through the presentation here today as well. And with that being said, it looks like we are live on all the different platforms. So we'll go ahead and get started. Again, keep dropping comments there in the chat and drop any questions you have as well. Jose will be happy to answer them as we go through the presentation here. So welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, and I'm joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans, and what we do on these trainings every Tuesday and Wednesday evening at 7 p.m. Eastern is do essentially a training on a different loan type or loan topic. Today, we're going to be talking about how to quote and structure ground up construction loans. So I was saying earlier, we did this with fix and flips previously, and today we'll talk about ground up construction. So Jose, our sales manager with 28 years of experience as a loan officer and a realtor, is going to take us through some ground up construction. So Jose, go ahead.
Good evening, everybody. Thank you for joining us for tonight's training. So, like I was mentioning, last week we had fix and flip and ground up construction, very similar. But what I will state about ground up is that the requirements are similar, but except for the experience requirement, right? Fix flip is lenient regarding borrowers with zero fixed flip loan experience, whereas ground up construction is not, right? They do require some experience, right? So now there's different ways to get around this, which I'll explain in the presentation as I get into it, but I did not want our audience today to confuse fix flip for ground up. Now, obviously, ground up is much more intense and involved, hence the additional experience requirement. So tonight we're going to delve into quoting, structuring. But in terms of quoting, I'm not actually going to be quoting a ground up. I'm going to let you know what the information you need from the borrower to be able to quote the ground up. So let's get into it. So what exactly is a ground up construction loan, right? A ground up construction loan is a short-term bridge loan designed to help investors build a spec home. It allows for the purchase of the lot as well as construction of the home. Now, let me back up a minute and explain what is a spec home. That's basically a home that an investor is building to sell for profit, right? That's what a spec home is. Now, a ground up construction loan is not a renovation loan like a FHA 203K or Fannie Mae home style. Like I already mentioned, it's not a fixed flip loan. And it is not a one-time close loan either. Why is it not a one-time close loan? Because one-time close loans are for primary home owners and second home owners only. You do not have one-time close loans for investment properties. That is what a ground-up construction loan is. Like I just said there in the third bullet point, only for investment properties. I doubt you're going to have any $50,000 loan amount for a construction loan, ground up construction loan, but we do go $50,000 to $5 million. Higher loan amounts on a case-by-case basis, because then it would have to be some serious vetting of the investor. Now, I would state we're going over the guidelines today of our ground up construction internal product, let's call it that. But we do have options where for developers, for doing a whole development, where it will be more than $5 million, of course. So that's a different product. But what we're going into today is the more common ground up construction for the investor that wants to build one home, right? That's what we're doing here. So again, like I mentioned, in the fixed flip loan, you have to plan for the exit strategy. That is critical, because one of the things that the underwriters and our conduits, where we will be funding these loans, look for is what's the viability of the deal, not just the profit margin in the deal, but are you going to be able to get out of that deal, that property, once it's built. So that's why it's so important to have that market analysis really on point, right? You want to make sure you collaborate with all your realtors and make sure that you have a solid number for your market analysis. Another thing that's going to be taken into consideration is, are you planning on selling the property, or are you planning on keeping it as a rental? Again, one reason why the market analysis is important for the sale, but also the rental rates are very important, because most investors tend to keep, when they do keep the property, they keep it via a DSCR loan, our favorite loan, which uses the income generated by the property, the gross rental income, to qualify the borrower, right? Gross rental income divided by housing expense. That gives you your debt service coverage ratio, which is what DSCR is an acronym for. So it's real important you discuss this with your investors and see how they plan to exit the property, by selling or by refinancing into an end loan, and make sure that you discuss with them what income type they plan to use for that loan. If they're going to go full doc, traditional full doc, or if they're going to go bank statement, P&L, 1099, or, as most of our experienced investors prefer, are they going to use the DSCR loan? So let's cover some of the items here, terms and ground up construction guidelines. I know the type's a little small for you there, but when you do get your hands on the presentation, you'll be able to look at it like I am on a bigger screen. But we covered some of these terms the other day, so I'll cover them again. Recourse loan, and these loans are recourse loans, the ones I'm going over right now, means that the loan is personally guaranteed by the borrower. If it's non-recourse, that means it's not personally guaranteed. The ARV, which is you're gonna have to order an ARV appraisal. ARV stands for after repaired value, which is the value after the construction is completed. And the as is value is the value of the property in its current condition. In this case, would be the value of the land in its current condition, since there is not a structure in there. Your construction budget is the total cost to complete the build, including hard and soft costs. Soft costs being permits, reports, and tests like soil compaction test. And hard costs are your actual construction expenses, right? Your materials, labor, contractor overhead. Minimum credit score for this product is 620. The term is up to 18 months for the regular ground up program and up to 24 months for the experienced developer program, and up to 90% loan to cost. But let me read a little bit more in the details in our guidelines there. So there's two ground up construction programs that we're talking about here with these particular guidelines, or should I say two paths. One is the quote unquote regular ground up program, meaning not for your experienced developer, right? Because there's an experienced developer program when they're doing more properties. So on the regular ground up, it's minimum one property, but maximum two. In the experienced developer program, where they have at least three or more similar projects in the past 3 years, it's a minimum one property, maximum 10 properties. Right now, eligible properties for this particular program we're talking about here, for these two, we're looking at non-owner occupied. That's very important to note. Remember, non-owner occupied 1 to 4 unit residential properties, townhomes, and condos. Ineligible for these two products we're talking about here are mixed use properties, 5+ unit multifamily properties, condo hotels, co-ops, commercial property, log homes, property subject to oil or gas leases, operating farms, ranches, or orchards, vacation or seasonal rentals, or rural properties. We do have options for these properties, just not with these particular guidelines, which are the best guidelines that we have. That's why they're a little tighter. But I mean, imagine we're talking 90% loan to cost, which is really important. So, one thing to note on the ground up construction is how they do the initial disbursement, right? In other words, that's going to cover usually the land purchase and that initial draw. So they're going to go to up to 75% of the lower of the land value or purchase price, right? So the lower of land value or purchase price, 75% of that. Now, if your project is unpermitted, right, you still got to do the permits, then the maximum initial disbursement is 60%, right? Not 75. And still always 100% of the construction. Now, for our regular ground up program, not the experienced developer program that has three or more similar projects in the past, it's 85% total project cost is the max, right? Note that, whereas our experienced developer is 90% of total project cost. And the disbursement at closing is the same, up to 75% of the lower of the land value or purchase price, and 60% if unpermitted, and always 100% of construction. Now, interest reserve is going to be minimum 1 month, but again, when they size up the risk in the deal, right? Because notice there's a disclaimer in the guidelines say these represent general guidelines and loan terms are subject to lender discretion, meaning after they review the deal, reach a proper risk assessment, then they'll lay down what they actually need. Maximum loan to ARV, because remember, there's different ways that they look at this, right? The loan to cost and loan to ARV, and it's always going to be the lower of all of those numbers. So also keep in mind then maximum loan to ARV is 70%. So if your ARV is, not spectacular, it could be that 70% of ARV is what's going to limit your loan amount, as opposed to 85% of total project cost. So they look at all of these numbers and always go with the lowest. So if you do have the 90% loan to cost loan, they're going to ask for minimum 6 months interest reserve if you're taking it to the max. And then on a regular ground up program, it's 12 months normal term up to 18 months at lender discretion. And the experienced developer program, 12 months regular term up to 24 months lender discretion. Uh, Now, in terms of developments, the minimum FICO score is minimum 620. However, if they're doing a development, in other words, more than one property at a time for a development, then it's higher risk. That's a minimum 680 credit score. So, experience is critical for ground up construction loans. You need a minimum of 1 to 2 ground ups in the last 3 years and 3+ if you're trying to qualify under the experienced developer program. Now, here's something that's important to note is general contractors. General contractors may use their build experience to meet the experience requirement. Now, it's pretty cool because in some cases, they don't let that happen. It's like you have to have the build experience as an owner of the project and not as a GC who has building experience. In this case, with these guidelines, we do let GC experience come into play. Right. Now, guarantors with no experience are permitted on a case by case basis. What does that mean? They're going to review the deal, they're going to review the risk in the deal. But what I can probably say is that if they do approve it, right, if they think, okay, the deal has a good amount of meat on the bones, right, that's going to be an exception, and the LTV or LTC is going to be cut, either the loan to value or the loan to cost. Usually the one we're worried about here is going to be cut. Right? So that's really important. Net worth and liquidity is another important factor there. For both programs, you need a minimum net worth of 10% of the loan amount. And net worth is basically assets minus liabilities. It does not mean cash in the bank. It's just your net worth from a personal financial statement that would be turned in. For the experienced developer program, they add an additional way you can do it. You can provide bank statements showing 10% of the loan amount post-close liquidity for developments. So it looks like they add an extra little rung there that you have to jump through for experienced developer programs, because those, if they're building multiple homes, then that's a little bit higher risk. So on the experienced developer program, when we're looking at previous real estate experience required, they're talking 3+ similar ground up builds plus heavy rehabs with expansion, right? Professional development builder. I mean, they really want to make sure that they qualify you with experience, right? And they're on the profit test on the deal, minimum 30% ROI, that is return on your investment. If the deal doesn't have at least 30% ROI, then it must pass a DSCR test of 1.2 based on a 30-year fixed rate mortgage at market rates. What is market rate? I guess they would have to let us know what they consider market rate. So really important that you are aware of all of these experience requirements, and also be aware that they do grant exceptions where it says guarantors with no experience permitted on a case-by-case basis. But that's for the ground up program. Now, however, for the experienced developer program, you got to read it carefully, because it says guarantors with no experience permitted with experienced guarantor that meets the above experience criteria. So, in other words, if your GC who you're working with, who may be also a partner on your deal, or whoever, maybe you have a partner on the deal that has experience and you don't have experience, then as long as your partner meets the experience level for guarantors, they will consider you. However, you need at least one of the two needs to meet the experience criteria. That's the other difference between the regular ground up and the experienced developer program. But typically, the experienced developer program is going to be used when more than one property is being built at the same time. And let's talk a little bit about insurance, right? I know you probably can't read that. It was a little blurry for me itself, but you can read it when you get your hands on the presentation. But I'll cover the important bullet points for you. Property coverage can be for your ground up construction insurance. The coverage needs to be one of two options: either replacement cost, as determined by an RCE, which is an acronym for the replacement cost estimate, or the loan value, right? So you need to either have a policy for the replacement cost of the structure or for the loan value, and it has to be an agreed value policy or zero coinsurance policy, and both can only have a max deductible of $5,000. That's not a very high deductible. The insurance carrier must be A rated with a 7, I would assume that's what VII, Roman numeral 7 or greater rating through AM Best. General liability limits not less than 1 million for each occurrence and 2 million aggregate. And if there is coinsurance, it has to be 80-0 or 80-0 agreed value. And I'm sure your insurance agent will know what that means. And the policy type, it depends if it's a home or if it's commercial. If it's a home, it needs to be either a broad or special form. And if it's commercial, it needs to be either a basic or special form. So, covered guidelines. Now let's cover and document requirements. Now let's talk a little bit about when you are vetting your borrower, right? It all comes together here with this form. Now, these are you need answers. You don't necessarily have to send this to the borrower and have them complete it or anything like that, but these are the questions that you need because basically you've reviewed the guidelines, right? Confirm the borrower meets them. You get these questions answered, and then you will run the scenario through the pricer, because when you are using the online pricer, these are the questions that you're going to have to input, or most of these are going to be questions, especially stuff like the ARV and property address, bill budget, as is value of the lot, purchase price of the lot structure, exit strategy. All those things that you see on this list are usually going to have to be input in the pricer. So, and as you note here, as I previously mentioned, experience is key. That's the big borrower experience with ground up is the biggest factor considered. The less the experience, the lower the leverage. In other words, the loan amount. So borrowers with no or low experience needing higher leverage can get a partner, like I mentioned, do a joint venture if needed to get the leverage you need. Because for the ground up, if it's a solid project and maybe you have heavy fix flip experience, right? At least 3 or more in the last 3 years, there's a good probability you'll get the ground up construction loan, but you may not get the leverage that you're looking for, right? Because they're going to limit it because it's higher risk, in which case you may need to bring in a partner and do it as a joint venture. Profit from the deal is the income that is analyzed, as borrower's personal nor business income has absolutely no impact on the underwriting of the loan. None at all. I mean, they're going to look at credit, and that's what's going to let them know if the borrower is good for it. They're going to look at this personal financial statement. They're going to look at the other factors on reserves and all that kind of stuff, but they're not going to look at the borrower's income. They're going to look at the profit from the deal. I already mentioned 620 minimum credit score. Anything lower is going to require an exception. And on the assets, borrower is going to obviously need to demonstrate enough assets to cover down payment, closing costs, reserve requirements, and show a net worth of at least 10% of the loan amount. Now, properties, I mentioned the property types that are possible under this program, 1 to 4 unit being the most common. And in this particular program, we can't do commercial or multifamily, but we do have other ground-up construction loan programs with different guidelines for those. So last I shared with you what are the items that are needed for the loan application. They're very similar to the items needed for the fixed flip loan, right? I mean, pretty much the same. They're just going to be analyzed differently because of the different requirements. For example, for net worth, fixed flip did not have a net worth requirement equal to 10% of the loan amount. You just got to meet whatever the reserve requirements are, and that's it. But the items needed are very basic: copy of the driver's license, a personal financial statement. Now that's pretty generic. Now, however, this particular conduit does have a personal financial statement they like us to use, but normally they're all the same. Assets, liabilities, right? That's what's on a personal financial statement, and your net worth at the end. Tri-merge credit report and a background check. Background check is, I guess, known in the industry as a fraud guard, right? That's what a background check is, because fraud guard looks into all those factors that they're interested in here. Purchase contract, obviously, or HUD to verify the purchase price. Your track record, that's going to be on an Excel spreadsheet. 3 latest bank statements, and if an LLC, you need your LLC docs, right? Certificate of formation, operating agreement, certificate of good standing, and not mentioned here, the EIN letter that you get from the IRS. And if a corporation, pretty similar, it's just different names, right? Articles of incorporation, corporate bylaw, certificate of good standing, and also the EIN letter from the IRS. Appraisal is ordered at submission. Once the submission is completed and your file has been accepted, at that point you can order the appraisal, and it's going to be an ARV appraisal for this type of loan. So again, looking forward to assisting you all with these ground-up construction loans. They're not that difficult if you just follow the basic steps. The guidelines are really not that complicated. They're much more complicated when you're looking at guidelines for any other loan is going to have more than a one-page guideline like these loans have. But again, remember the important points here. Experience. Buyer experience is going to be key. That's probably one of the first things you want to touch on when you are interviewing the borrower is their experience level, because if it's 0, then you may want to suggest they're getting a joint venture. And then, like I mentioned, we do have an option for limited experience, but they'll advertise 1 month, hey, yeah, we got it with no experience. Then next month they add experience, and then they go back to no experience. So it's all depending on how they feel that month, how secondary is treating them as to if no experience level will be accepted.
All right. Well, surprisingly, I don't see any questions. So I guess you did a good job there, Jose.
Well, awesome. Yeah, and I was good that I'm doing this because I'm working on a ground-up construction quote myself. Very, very interesting loans. As the key is to make sure that you pre-educate your borrower, letting them know everything that you need up front, so that hopefully they get you everything you need to be able to provide an accurate quote, because they all want that quote yesterday, which is great, but they have to give you all the information, accurate information, so that you can help them with their needs.
All right, so still no questions. So I think we can go ahead and wrap it up. Remember, Tuesdays and Wednesdays, 7 p.m. Eastern time, we do these trainings. So we'll be back tomorrow with a different topic here to go through. So we appreciate everybody tuning in. Thank you, Jose. Great presentation. And we'll see you all tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training with the Mortgage Calculator. Have a great night, everyone.
Thank you, everybody.